and welcome back to International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, the home buyer coach on KCAA Broadcasting Network, 1050 AM and 106.5 FM. If you've missed any of our previous shows, you can watch us on our TV streaming channel, distribution on Roku TV, Amazon Fire TV, and the Android app. Just subscribe to the Building Solid Foundations channel to see our previous shows. Thank you for coming back. We are going to talk about adjustable rate mortgages, or sometimes called variable rate loans. Usually when we have fixed rate interest rates moving in the upward direction, a variable rate or an adjustable rate or an ARM, adjustable rate mortgage, become a popular option. But lately we haven't seen that this is very popular because the spread between the fixed rate and the adjustable isn't attractive enough to take the risk of that rate adjusting. I think also there's a little bit of fear in the market about adjustable rate mortgages because of what happened in the past with adjustable rate mortgages. So some people are leery of it, and I think investors are as well about the performance. But if it becomes an option that you have to take for helping you to afford a home or keep your payment down initially, then you need to know how it works. So I want to explain all of the components of a variable interest rate to you, an adjustable rate mortgage, so that you know what to look for and how to understand what's going to happen on your interest rate and your monthly payments if you choose a variable rate. Now, for the sake of this example, I think it's best to use maybe a home equity line of credit as an example, because that is a little more popular right now, and maybe something that you might look at if you already are a homeowner and want to take equity out of your home. You might look at a home equity line of credit, which is generally a variable rate type of product. So we're going to start with each of the components. There is a fixed component and a variable component to the interest rate on your adjustable rate mortgage. The variable rate portion, or the moving portion, is an index. An index is the performance of a group of assets measured in a standardized way. So it's like an index regarding a fund, or like a group of assets. So for the sake of ease, we're going to use prime rate to talk about this. So prime rate is a popular index used for home equity line of credit. And today the value of prime is 7.750, and it has been going up with everything else. So 7.75 is prime. And the fixed rate portion of a variable rate loan is called the margin. Now, the margin is based more on your current circumstances. It has to do with your FICO score, the state that you're borrowing in, the type of property that you have, the loan to value. Loan to value means how much is the collective loans in relationship to the value of your property. So let's say you have a $300,000 first mortgage balance, and you want to borrow $100,000. So that's, let's say you have a $200,000 first mortgage balance, and you want to borrow $100,000 home equity line of credit. Your total amount is $300,000. Let's say your property's worth $600,000. So you owe 50% of the overall value of your property. So that is called the loan to value. So each of these type of variables that have to do with your specific condition comes along with a little cost. We add those little costs together to come up with the margin. So for the sake of ease, we're going to say that prime is 7, a round number, and we're going to say your margin ends up being 3%. So we're going to say 7 plus 3 is your start rate, which is 10%. So on this variable rate loan, your start rate is going to be 10%. The next thing that you need to know is the frequency of the adjustments. How often is the rate going to adjust? Is it going to adjust monthly, 6 months, 12 months, 3 years, 5 years, and so on? If your interest rate, let's say, is going to adjust every 6 months, that's the frequency of adjustment. So at 6 months, they're going to take a look at what prime value is then. And then right after that, the payment that's due right after that adjustment will be at the new rate if the index has changed. So if prime then goes up, then your interest rate's going to go up. So let's say, for sake of ease, in the prime goes up 0.5% in the 6 months. So it was 7, now it's 7.5. That's a variable portion, and your margin remains fixed. It's 3%. So now we're going to take the 8 plus the 3, and now your rate's 11 for the next 6 months, and then so on. So let's say 6 months from then, which was a year anniversary of your loan, prime goes down back to 7. Then your margin is fixed, your prime changed to 7, and now your rate is 10 again for the next 6 months, because the frequency of adjustment is 6 months. The next thing you need to know is how high the rate can go. What is the maximum cap? And then in addition to that, what is the cap for each adjustment? Every 6 months, if prime goes sky high, does that mean my rate does? If there's a cap on the lifetime and there's a cap on each adjustment. So you need to know what those caps are. Generally speaking, let's say each adjustment has a 2% cap. That would mean that even if prime goes up more than 2%, your rate can only change 2%. So let's say that in the first adjustment, prime is 7 and it goes to 10. That's a 3% increase, but you have a 2% cap, so it can only go to 9. That's the maximum it can go. And then 9 and 3 is 12, so now your rate is 12%. And then the next adjustment can have a maximum increase of 2. Let's say there's a lifetime cap on this loan at 18%. So the maximum for the life of loan that your rate can go up is to 18%. And the maximum it can change each adjustment period, which is in our scenario 6 months, it can go up 2%. Now the rate prime can go down, and so the rate can go down or it can go up based on that index, the movement of that index. The margin remains the same at 3% in this scenario. Now there's also a floor. So they can say, how low can the rate go? If prime starts to go in the downward direction, how low can my rate go? Well, it can be a number. The floor can be 5 and the max cap can be 18. But generally speaking, you might have a floor that is your start rate. So if your start rate was 10, the lowest it can go is 10, and the highest it can go is 18. Let's say it could go to 5. Since your margin is fixed at 3, in order for it to go to 5, that would mean that prime would have to be valued at 2%. So if prime went down to 2%, your margin stays fixed at 3. Now your rate is 5. And if your floor is 5, then your rate can go down to 5. Now, obviously, it's going to depend on the information of your particular loan. Whatever your floor and your ceiling and your caps and your frequency of adjustment and your margin and what index it's tied to. Those are all the components for that. Now, as far as paying back a variable rate mortgage, some variable rates and HELOCs offer an interest-only period. And that is where you only have to pay the interest that is due, or the interest that has calculated on each month. So let's say you borrow a $50,000 home equity line of credit and your interest only payment starts out at $500 and you borrowed $50,000. You pay $500 per month, but you still owe $50,000 because you didn't pay any towards the principal. So it's ideal to pay principal when you can. It's also nice to have a lower payment and pay interest only, but you'll owe $50,000 for the period of time that you pay interest only and you never pay principal. So it would be ideal if you paid interest only $500 and principal $500 so that your principal balance is going down. Because then 6 months you're going to have an adjustment, and then let's say your interest only payment goes to $600. If you're paying the $1,000 per month, now it's going to be $600 to interest and $400 to principal. So if your loan has an interest only period, it's going to have something that happens after that interest only period. On a home equity line of credit, it might be a 10-year interest only period and then 20 years to pay back the entire loan. So if you owed $50,000, you didn't pay any principal in 10 years, you're going to go $50,000 still after the 10 years, and they're going to take that $50,000 and they're going to amortize it over 20 years. Now you're going to have a payment that is equally, or portion of it is interest and a portion of it is principal, and it will pay off in 20 years, and you won't be borrowing anymore. but it still could have a variable component. So if it's going to pay off in 20 years, each time that rate adjusts, your payment is going to go up enough to be paid off in full in 20 years. So those are all of the components of a variable rate. I'll just run through them real quick. It's the index, which is the variable portion, the margin, which is fixed, the frequency of adjustments, the cap per adjustment, the maximum the rate can go, and the lowest that the rate can go, and whether or not you're paying back principal and interest or interest only, and for how long that will happen. So I hope that this was a good lesson on how a variable rate mortgage works, so that in case if that becomes an option that's attractive and helpful for you to do in order to finance a property, that you'll understand all of the components of a variable rate mortgage. Thank you for joining me on this segment. In the next segment, we are going to talk about what affects interest rates, what makes them go up potentially, and what makes them go down. And we'll look at all of the areas that affect us in the interest rate market. So I will see you soon in the next segment.